Welcome to the MaxLife Commercial Academy. I'm glad you're here. This is Course 1, Introduction to Commercial Real Estate. And if you've ever wondered why some investors seem to build wealth faster than everyone else, this course is where that answer starts. We're going to cover what commercial real estate actually is, the 5 major asset classes, who the key players are, how investors make money, and whether CRE is the right path for you. Let's get into it. Here's the one-sentence definition you need to know. Commercial real estate is any property that generates income by being leased to a business or multiple tenants, or held as an asset for business use. That's it. Everything else is detail. The word commercial doesn't mean big, downtown, or expensive. A 5-unit apartment building in a small Florida town is commercial real estate. A single AutoZone store on a lonely highway is commercial real estate. A 40-acre raw land parcel being held for a future Walmart is commercial real estate. What makes it commercial is not the building, it's the purpose. The property exists to produce income or support a business operation, not to house a family as their primary residence. The cleanest dividing line most people use is the 5+ unit rule. A 1 to 4 unit property is financed like a house, residential loan, residential rules. A 5 or more unit property is financed as commercial. That's why so many investors make a small apartment building their first commercial deal. It's the smallest step across the line. Every piece of commercial real estate creates wealth through one or more of 4 income streams. First, rental income. Tenants pay you rent to occupy the space. That's your primary cash flow. Second, capital appreciation. The property value rises over time, both as the market grows and as you increase the net operating income. Third, tax benefits. This is where CRE gets really interesting. Depreciation, 1031 exchanges, cost segregation, and bonus depreciation can shield enormous amounts of income from taxes. Commercial real estate is one of the most powerful tax shelters legally available to investors. Fourth, principal pay down. Every month, your tenant's rent payment pays down your mortgage, quietly building equity without you doing anything. Residential real estate has these same 4 streams, but the scale, the math, and the buyers are completely different. A residential investor thinks about a mortgage payment and one tenant. A commercial investor thinks about net operating income, cap rates, and a multi-year business plan. The industry divides commercial real estate into 5 main asset classes, plus raw land, which most people forget about. Multifamily, apartment buildings with 5 or more units. This is the only commercial asset class where your tenant is a person rather than a business. The big advantage? Agency debt. Fannie Mae and Freddie Mac offer the best commercial loan terms in the market, but only for multifamily. Retail, properties leased to stores and restaurants. Freestanding retail with a strong national tenant, like a Chick-fil-A or a Dollar General, is often triple net leased, meaning the tenant pays taxes, insurance, and maintenance. Your job as the landlord is basically to collect the check. Office, buildings for professional use. This is the most challenged asset class post-COVID. Before buying office space in 2026, you need a strong thesis about why that specific building will stay occupied. The major exception is medical office. Healthcare tenants are sticky and hard to relocate. Industrial, warehouses, distribution centers, flex space. E-commerce has put industrial in a multi-decade supercycle. Every dollar of online sales requires roughly 3 times the warehouse space of the equivalent brick and mortar dollar. Specialty, the bucket for everything else. Self-storage, hotels, senior housing, data centers, car washes. These reward specialists don't dabble. And raw land, undeveloped parcels held for future commercial use, no income, carrying costs, and the entire return depends on what happens next. It's the riskiest category, and the source of some of the biggest wins in real estate. A commercial real estate deal involves more people than most new investors expect. Let's walk through who's in the room. The buyer or investor is taking ownership. Their goal is a return on capital through rent, appreciation, or both. The seller wants to maximize sale proceeds. Their motivation matters enormously. A tired landlord who's owned the building for 30 years is a very different negotiation than a developer selling a newly built property. The tenant is the business occupying the space. In commercial real estate, tenants sign multi-year leases and have far fewer legal protections than residential tenants, which is actually good for the landlord. The broker represents one or both sides and earns a commission, typically 3 to 6% of the sale price, split between both sides. The lender earns interest on the loan. Here's a pattern worth remembering. Lenders are often the most consistent earners in any deal. They get paid whether the investor wins or loses. And then there's the attorney, the developer, the property manager, each with their own fee structure. Knowing how everyone gets paid tells you where their interests align with yours and where they don't. That's the foundation of negotiating well. Here is the single biggest difference between commercial and residential real estate, and the reason sophisticated investors prefer commercial. Residential properties are valued on comparable sales. Your house is worth whatever the house next door sold for. As an owner, you control almost nothing about that number. Commercial properties are valued on income. Specifically, net operating income divided by the cap rate equals property value. What this means in practice: if you increase your rents, or reduce your vacancy rate, or cut your operating expenses, you have directly increased the value of your property. You manufactured equity. That is not something you can do with a house. This income-based valuation model is why commercial investors talk about adding value through operations, not just through waiting for the market to go up. A skilled operator can double the value of a commercial property in 5 years without the market moving at all, simply by improving the income. That's a fundamentally different game, and it's why CRE builds generational wealth faster than almost any other asset class. Commercial real estate is not for everyone, and that's actually one of its advantages. The barrier to entry keeps competition lower than residential. CRE is a good fit if you think in terms of business rather than just property. If you can handle longer timelines, deals take 6 to 18 months from first look to close. If you have access to capital or you're willing to learn how to raise it from other investors. And if you're willing to pick a lane and go deep, instead of dabbling in every asset class. It's not a good fit if you're expecting truly passive income with zero learning curve, or if you want quick flips for fast cash. That's not how commercial works. Or if you're not willing to learn the financial metrics: NOI, cap rate, debt service coverage ratio, and internal rate of return. The good news is none of those skills are hard to learn. That's what this academy is for. If you've made it this far, you're already showing the right instincts. In the next course, we go deeper on the terminology and key metrics every CRE investor needs to know. Let's recap what we covered in this course. Commercial real estate is any property that generates income by being leased to a business or held for business use. It's valued on income, specifically NOI divided by cap rate, which means you, as the owner, directly control the value of your asset. There are 5 major asset classes: multifamily, retail, office, industrial, and specialty, plus raw land. Each has its own economics, its own cap rate ranges, and its own rules. Good investors specialize. Every CRE investment builds wealth through 4 streams at once: rental income, appreciation, tax benefits, and principal paydown. In Course 2, we go deep on the terminology and financial metrics: cap rates, NOI, debt service coverage, cash on cash return, and the numbers every CRE investor needs to be fluent in. Thanks for watching. I'm Ryan Solberg with MaxLife Commercial. If you found this valuable, subscribe and continue through the full academy at maxlifedevelopment.com/academy. See you in the next course.